So just for the benefit of it, for the session, I'm going to just start again. So what we're looking at doing is continuing with our coverage of Unit 6, which is basically Introduction to Finance. And in this, I'm going to be taking up, Learning Outcome 2 in today's session. And the Learning Outcome 2 essentially focuses on, understanding when, in the previous session, what we've done is we've understood how does a business approach the issues of finance. For example, if you're a business and you need some funding or you need additional money to be invested into the business, what are the various ways through which you can arrange finance? So you could go to a bank, you could look at a shares issue, you could look at, for example, issuing bonds. In some cases, if the business has been running for a number of years, it can bring its own retained profits to look at further investments or capital investments. So when we understood what are the various sources through which you can arrange finance, what we want to be able to do now is basically extend that knowledge of ours into the second learning outcome, which is to understand what is the cost of that source of finance. How much interest rate do you pay if you borrow money from the bank? Because at the end of the day, getting money is fine, but what you need to know is what is the cost of borrowing. So what we're going to look at today is understanding a bit on sources of finance, but extend that understanding into what is the cost and what, when you arrange what type of finance. So if it's debentures, if it's bonds, if it's shares, or it's an overdraft or bank loan, short-term, long-term, what is the cost of arranging that source of finance is what we will look at. The second thing that we're going to cover today would be looking at, the importance of financial planning. Now, we do a lot of financial planning at our own personal self as well, for our own personal self. So, for example, if you go back to and remember, say, for example, as children, you used to get some pocket money from your parents. And that pocket money, essentially, you kind of, maximize in terms of what you want to get on a weekly, monthly basis. Now, as you grow and obviously start working, you obviously have a salary or a wage, and then you look at doing some financial planning when you get your salary, that how much of that will go into, say, your rent or, your fuel or food and expenses and things like that. So similarly, in the context of a business, what we are going to look at is primarily look at understanding what is financial planning. How do we plan our finances? And in the case of business, what does this financial planning entail? What does it include? And then what we will look at towards the end would be try and understand if you are a finance manager or if you are a person working within a business who has the responsibility of managing funds or managing capital, managing money, managing finances. They're all interchangeable terms. So depending on the organization that you work, if you're working in a small business, normally it will be called I'm managing, money, because you're the purchase manager, you're also the accounts manager, you're receiving and also making purchases. But if you go into a bigger firm in terms of scale of operation, there the term money would become would interchange to something like capital, because you will have different source of incomes, and those different source of incomes would require different type of planning. An example would be you have money coming in and going out on a daily basis, and that could become working capital. There will be money which will be required for you to invest into certain projects. So if you look at a builder, somebody as a company which they are looking at building a lot of houses, or they have lots of development, in which the houses are being built in different areas, then that as a company would have a requirement of working capital, and that working capital would be required in multiple sites. So the meaning of the working capital in certain contexts would essentially, the term essentially would change depending on the source of operations that we are looking at. So let's look at getting on with what I'm going to do is get on with primarily a few slides which will explain some of the things that we are looking at getting into. Now, if you're asking me questions, my session would be you can unmute your mic, but if you're not asking me any questions, then at this stage just in order to avoid any background disturbance, just mute your mic on your side. I can do that as well, but then I don't know when you want to ask me questions. You'll have to, put in something into a chat box, so I know that you have a question that you're asking me, and I'll pick up that question to, answer and, look at that query at that point in time. So is it okay if I start with this?
Yeah.
Okay, good stuff. So broadly speaking, some areas of finance that we look at, from a business perspective would be, when you require finance for business growth, that means you're looking at expanding your business. Sometimes when you look at sources of finance, we also look at, getting sources which is investment coming into the company, and that investment would be something called venture capital. Now, when you are startup, when you're as a business, when you're a startup, and you have, say, for example, most of the Silicon Valley companies, when we look at most of the companies which are, started after 2000, a lot of these companies have a lot of valuation on the stock market. Now, when they started off as a business, they had most of the investment primarily from the owner or, from the co-founders. But as they are looking at expanding, what they did was they went across to a lot of venture capitalists or business angels, as we call them. And these are the people which buy stake within the company because they believe that, there is a merit in the idea, or there's a merit in the service which the company is trying to develop. What they do is they become the first investors in the company, and then they go in, and in exchange for example, control, in exchange for some shares, or, in exchange for ownership of the company, part ownership of the company, what they do is they kind of, end up investing into the business. And this investment, which normally is long-term, is something which they do not look at withdrawing, is an investment which is normally done through two routes. And one of the routes is venture capitalists, people who are entrepreneurs or serial entrepreneurs. They have lots of money. And what they do is they seek out investment in businesses which they can do from time to time to be able to grow that business because of the expertise and experience they've got over the years. And then when you look at business angels are typically type of consortiums or let's put it this way, groups which look at investing into businesses which have promise. That means they would want to kind of work between, these are people which essentially work between venture capitalists or people like banks and venture capitalists, people who have the money or capital to be able to invest into a business and advise the owners to be able to look at, where you need to make investment. So essentially the difference between the two would be, if I have to define, business angels would be people who are, they have a lot of wealth. They are entrepreneurial, obviously, in their nature, and they are people who are willing to invest in the business in return for some sort of an equity or a shareholding in the business or the company. And they normally tend to take, risk because they go with the merit of the idea, and then they feel that this idea is meritorious enough and can lead to a big business. Then at that stage, what they do is they take that risk and they say, okay, I would want to invest into this and take some shareholding, and then basically become a part and parcel of the business. So an example here would be when you look at Mark Zuckerberg, when he looked at starting Facebook, which started off as a college social network, but at some stage when they were looking at getting more investment into the business, and because he was studying in the college, what he did was he got in touch with one of his friends whose father was a merchant banker and an investment banker. And when they presented the idea to him, what they said is, okay, my son would also become a partner in the business. And that is how they managed to secure income or, initial set of money at that point in time when they wanted to expand beyond the college network and, make this into a full-fledged business. When, he then essentially dropped out of Harvard, and then both of these, both of these friends actually went into creating Facebook, from that aspect. So the difference here was the person, his friend that he knew, his father was a merchant banker, so he initially put some investment in, and beyond that, when the business became, a little bigger business, when they needed more investment, then they went across to the formal channels of getting funding, and that was primarily through venture capitalists. So these are three, broad sources of finance. But obviously, when we expand this further, we will look at, that business growth in most cases typically can happen through internal and external sources of finance. And here, when we look at internal sources of finance, we basically look at, funding happening for organic growth. That means growth which is generated through development and expansion of business itself. So if you're a setup business and that business is now running for a number of years, what tends to happen is that because the business is generating cash or profits, you're able to redeploy those profits back into the company to be able to expand operations. So if a simple example is taken of a delivery firm like Deliveroo in the UK, they are a franchise business, but what they typically do is if they want to expand, because the business is generating money on a daily basis, they deliver exotic, food which you can order from restaurants, from any restaurants, and they deliver it to the confines of your home. Now, if they look at expanding or taking up another area, which means that they need to open up a hub, what they do is, because the business is generating income, they do not need to go out and essentially seek a loan or an overdraft or borrow money from the bank. Because the business is generating profits, they are able to take that decision internally, and this is primarily looking at growing organically, but the funds and the sources are coming from within the company. The reason why that happens is, which is a follow-up reason, is that it is generating enough sales for it to have investments or maybe profits, and that increasing revenue or sales which is increasing is providing them more money, more revenue, and that has allowed them to accumulate profits, which then can be put into investment. So the second and the third point, when you look at, they're all related. So organic growth means the growth which can be fueled from within the company, because there are enough sales happening, there is enough revenue or money coming in, and those are then generating profits, which then are reinvested into the business. Now, in some cases, you will also see that some companies would look at selling their assets. Now, if you look at companies which basically sprung up and in the 1980s, and they acquired a lot of land, or they acquired, for example, a lot of spaces or licenses. So look at the example of UK or maybe any other country wherein typically you look at large retailers which initially came into retailing business, which is either food, grocery, or electronic retailing. They ended up taking up spaces in very good locations. Now, over a point in time, because the cities have expanded and the locations have expanded, and then to a certain extent, maybe in the last 30, 40 years, if the business has consolidated, that means they do not want to have outlets every 1 mile or every 2 miles. What they've done is they have looked at selling some of those real estate places, because they do feel either they need a bigger place, or if they sell that place out, that can return some profit or money back to the company, because that is an asset. And that asset, when it gets sold, the company generally realizes, minus the tax that you pay to the government, it's not. Sometimes you will see companies sell off machinery in order to recover some costs, because they're buying new machinery, or have a lot of sites and those sites are being consolidated. So what they will do is they'll end up selling off one of the site, and that would basically mean that that money coming into the company through internal sources of finance, because it's an asset being sold on the balance sheet, and that generates income minus the tax, is again something which is hitting the company's bank account direct. Now, in terms of external sources of finance, when we talk about external, we talk about long-term and short-term. Now, you could borrow money from the bank for, say, buying a car, right? When you buy money for buying a car from the bank, you might buy it for 3 years. Loan would be for 3 years or 5 years, and this tends to be short-term. But imagine if you're looking at buying a house and you need to take out a mortgage from the bank. Now, this mortgage is basically or approximately about 20, 25, 30 years. And this is then, classified as something called long-term source of finance. So here you're paying a nominal rate of interest, but it is paid over a long period of time. And this would then be classified as something called long-term. Now, in the short term, because you're borrowing money and you're going to pay it back, in some cases, you will find that the interest rates on short-term sources of finance, when you borrow it for shorter number of, a shorter time frame, essentially, you will see that the rate of interest is normally slightly higher. So sometimes you will see companies borrow or businesses will borrow money for short term. Short term could be 2, 3, 4, 5 years. Long term would be 10, 15, 20 years. And this is because some businesses do not enjoy return on investment, which happens within a shorter time frame. So they have to look at sources of finance in which they borrow money and borrow money or capital, which is at a low interest rate, and that is then built into the cash flow. So every month you're paying some interest as well as you're paying some principal back, but that allows you to fund or expand the business. And this is generally seen to be happening in the case wherein you look at inorganic growth. That means you're trying to take over a company in terms of long-term finance. You're trying to buy out a company, you're trying to merge with another big company, and this tends to be an acquisition. So an example here would be, just sticking to the example of Facebook today. So if you look at Facebook over the years in terms of the business when it started, it has acquired a lot of smaller companies. I think the latest acquisition which I can recall, they acquired something called Snapdeal or Snapchat. And before that, they had acquired WhatsApp. Now, these businesses, when Facebook was looking at buying these businesses, say, let's look at WhatsApp, that business was already an established business. One of the reasons, whatever reasons they thought of that, it could be 1, 2, 3, like that they would acquire more customers because WhatsApp allows, internet calling through the, application, and which Facebook did not have. So they want to acquire the technology. They want to acquire the customer base. They also want to look at, growing quite quickly. So a lot of reasons could have been there. But when they decided to acquire, Facebook would have needed to shell out a lot of money. That means, I think if I remember correctly, Facebook bought out, WhatsApp at $8.2 billion. So $8.2 billion is not something which you will have in your bank, even if it's a big company like Facebook, which turns over, $25-30 billion a year in terms of sales. But that amount of money in cash sometimes is difficult to come about. So what they do is, if they decide to buy a company or if it's happening for inorganic growth, they would tend to borrow money from the banks or, from other institutions. And this borrowing of money will primarily happen, for a long term. And in this case, part of that money which you are borrowing would be in terms of, long term, and part of that would be short term. So the company would say, okay, if you're looking at buying out, you need to give us, the owners would say, you need to pay us 1 billion, say, for example, I'm just making the figure up, but it will be, they say 1 billion in cash, and then the rest 7 billion staggered over 2, 3, 4, 5 years, because they need to acquire the company, technology, a lot of transition needs to happen. And in this cases, what you will look at is, this tends to be then long-term sources of finance. Now, if I detail this out in this slide, that would mean there are other forms of long-term sources which the company can also generate on its own. So one of the key things that we hear is, a lot of companies, when they become successful, they have large operations, what they tend to do is they list on the share market. Now, when they list on the share market, they issue something called shares, and that would mean the ownership of the company. They're going to try and issue shares which will allow individual or members of the public to have ownership into the company. And these are then issued as ordinary shares or preferred shares, and they then give you certain different, rights in terms of different rights, basically in terms of working with the company or having ownership with the company. Now, the share issues are normally, or when the company decides to list on a stock exchange, these, this process typically happens once, in the lifetime of the company. So the company is looking at generating a lot of capital from the market in exchange by issuing shares. That means members of the public could become owners of the company, and they would issue, depending on, it could range from, 1 million shares to 20 million shares. And this then can also be a listing on one stock exchange, but it could be a listing on multiple stock exchanges across, the globe. So if you are a national player, you might just decide to list your company in a particular stock exchange in that country. But if you are international in terms of your business, this would mean that you could list your, you could float your company or your shares in different stock exchanges, and that would mean you're looking at generating more capital. Now, typically within the shares, there are lots of different types. There is something called the new share issue. There is something called the rights issue. And in some cases, there is a bonus or a scripts issue. Now, when we say new shares means, so this process, when we look at, if I have to understand and make you understand from a literal point of view, typically the share process normally follows three routes. One is when the company is listing out first time in the stock exchange. That means they will issue first time the shares, and you will generate some money and capital. People will buy out that share, and in return the company generates some capital which it can directly use for growth of the business, acquiring a company, expanding operations, whatever. Now, after the shares have been issued and the company has been trading for a number of years, what sometimes the company needs to do is they need to raise money again from the members of the public. So what they then do is they go out and basically look at a rights issue. The rights issue would mean that in some cases the company is looking at acquiring its shares back by offering higher value at which the shares were purchased. Or in some cases what they do is, if that is not supposed to happen or is not happening, then what they will do is they'll do a rights issue. That means they will want to make more members of public have ownership in the company, and they then issue more shares at discounted rate. So initially, if the shares were listed, say £10, and 2 years down the line, the company decides to raise money again from the share market or the equities market, what they will then have to do is issue shares at a lower value. So what they would do is issue shares at £5 a share, and that would allow the existing owners, which are shareholders, but also bring in new shareholders into the company, and that would normally happen at a discounted rate. Now, sometimes what the company does is, in order to look at expanding and in order to look at increasing ownership and getting more money, again, the whole advantage is that they want to get more money. What they do is, after the new shares have been issued, share issue has been brought out, rights issue has been brought out, what they do is they will look at splitting of equity in terms of share. They will basically look at creating more owners or more ownership because they want more money from the market. And in this case, what they do is they change the value of the share in terms of the market value. So if the share and the company is trading, initially they started at £10. When after 2 years, the share was trading at maybe £13-14, but they decided to bring out a rights issue, and that rights issue was at half the price of the trading price. So if it was trading at say £14, the rights issue comes out at £7. But again, after 2 years, they decide that, okay, the share is not increasing or, not increasing in the value. We need to generate or raise more money. What they then do is they come out with an issue or wherein they will basically increase the number of shares by reducing the value of the company in terms of market capitalization. Now, this is a term that we need to understand. Typically, if a company is listed in the share market, it also has something called a market capitalization. That means the number of shares which have been floated multiplied by the value of the share gives us the market capitalization of the company. Now, if we look at a company like Facebook today, or I think Apple, we look at Apple shares are trading at currently $135 to a share. Now, they have issued in excess of 200 million shares over the last 30 years. So if you multiply 200 million by $135, that gives you the market capitalization of Apple. That means if the Apple management today decides that they do not want any public ownership and they want to buy these shares back from the members of the public, what they will have to do is they will have to cough up this much money in order to buy those shares back from the shareholders. And that would basically mean this is the amount of money they have to basically have in the banks to be able to repurchase or get the ownership back into the hands of the company itself. So to a certain extent, the market capitalization also provides the benchmark in terms of how valuable the company is, because there are lots of people which have bought shares of the company and they have confidence within the company's products, services, whatever it is, and that's the reason they have invested money, because they do feel that the company returns, the return on investment, which is on the price that they've bought the shares, is something which they get as dividends, is happening year on year. and the confidence remains, and because of which the company's value the company's valuation in the market on the stock market tends to increase. So these are three types of share issues which the companies can actually look at to generate long-term finance. Any questions on this so far?
No.
Okay. Now, some of the other long-term sources of finance we look at is something called debentures. We also look at bank loans and mortgages. Sometimes you will see investment and merchant banking also taking up a stake within the company, and I'll explain that with an example. And in some cases, companies might also be able to raise money by getting government grants, or when I say EU is European Union grants, to grow the business. Now, in this, debentures are another form of raising money from the market. And here, what the company does is issues debentures or bonds in exchange for a fixed interest rate, which is paid to the person who buys the debentures or bonds. And these bonds are normally 3 years, 5 years. But when we talk about long-term, debentures are 10-year, 10, 15, and 20-year, bonds. So here, what tends to happen is that the company, if you decide to buy, say, for example, debentures for a company like Facebook or Apple, I don't know whether they've issued, but Apple definitely has. So what they will do is they issue this for a period of 10 years, and they will say, okay, we'll pay you a fixed rate of interest on the money that you're buying or investing to buy the debentures, say at 5%. Whether the market rate or market bank interest, goes to 2%, 3%, or 10%, they will still pay you a committed rate of interest on that. And then at the end of 10 years, when your debenture, actually matures, you will get your whole principal back. But you have essentially given them a loan, which is at a certain fixed rate of interest or return, and this is something they will pay you back on maturity. Bank loans and mortgages, it's simple to understand that you can go to your bank if you have a working cash, you have cash flows happening in the business. If your business is, churning over, say, for example, a turnover of, say 100,000 every month, what the bank would do is you go and have a discussion or a meeting with your bank manager. The bank would say, okay, because you're turning over that, if you need a bit of an overdraft or a need of a loan, then because your working capital is this much, risk associated are these, we could look at giving you, a bit of a loan, which is to the tune of 1.5 times the turnover every month, which is, say, 150,000. And they will charge a small amount of interest, and you're returning the principal and the interest, in that agreement. Now, merchant and investment banks, when we look at, here, what is happening is some banks like Barclays Bank would also have a lot of investment in terms of pension funds, debentures, bonds, and, people, when they look at putting their savings deposit into some sort of fixed deposits. Now, these banks over the years accumulate a lot of money which the customers have invested, and that money is locked in because they have either put into some sort of a fixed deposit or fixed deposit schemes, or they have put that money into, say, for example, it's still lying in the bank. Or if there are lots of other companies which will basically put in money in terms of pension funds or other kind of funds into a particular bank, and then money is lying. Now, what the bank would do is they would hedge some risk, and that risk, what they will do is they will look at what is the rate at which the people withdraw the money after having, certain cash flows or certain amount of money. They will reinvest some part of that money into other projects from which they can earn interest and also earn money in the long term. So when you look at the financial crisis, of the 2007, 2008, and when this financial crisis essentially happened, what it did was a lot of banks in the UK and in the US had invested money into something called real estate. That means they'd funded projects to, build housing and a couple of other things. And in that, the money, because the money was available, they started to reinvest. There was not proper due diligence done. And what tended to happen is that a lot of that did not end up coming back in terms of repayments and turned into something called toxic investments. And that is where merchant banking and investment banks were primarily held responsible for the financial crash or the crisis that we had in 2007, 2008. Now here, basically, the idea is a lot of money in the banks, which remains. The bank is under regulation to keep that money within the bank so that if the customers need to withdraw, they will withdraw. But sometimes banks act on behalf of the client to organize and underwrite some of the investments to raise more money. And this is what is called investment banking. So Barclays would say, okay, I can help you raise so much money, but in order to help you raise that money, we will charge you a certain amount of fees. But there are risks associated with that, because when they invest money into stock markets or reinvest that money into long-term bonds and debentures, sometimes you will see that the market yield or return on that seems to go down. And that means that the bonds or the budgets which they put in place are underperforming. But when the market is buoyant, because these mechanisms are used by banks essentially to raise money in the long term, they tend to deploy that because they see, okay, if the up and down is happening, but in the longer term, there is a steady revenue coming in from that investment, which could be in the form of, small increases in the rate of interest. So typically such businesses, with this kind of an investment, when money is raised, you're looking at starting with at least tens of hundreds of millions of dollars. You're not looking at, starting something with, $1 million or $2 million or, small amount of money. This is normally in multiples of 10 million. Now here the clients would come in and say, okay, I would want to put this investment, and this investment, I want this much rate of return. Now the banks would then hedge this risk and organize that money to be invested into projects which they feel could bring in return on investment which the client is asking for. And this also allows them to reinvest the money into projects which they feel can have better yield or rate of interest, and that is where they make money, and then their client makes money. Now, last but not the least, and a good example of this would be when you work within the public sector, what you tend to see is you have pension funds. Now, pension funds, when you sign up for a pension, what they tend to do is you are putting away some part of your income every month, 2%, 3%, 4%, part contribution by the employer, part contribution by the company, and that money is going into some sort of a pension pot. Now that pension pot is essentially being reinvested by the bank to see how your pension can perform over 25, 30 years by the time you retire. So you're putting in small amounts of money, but they are reinvesting that money into other growth-related projects, and those growth-related projects should return a higher rate of return in terms of interest, and that should help your money to grow. But sometimes you see that there is you get to hear these terms that there is a hole in the pensions pot. That means the pensions fund investment, wherever they've done, is underperforming than what was initially calculated. And that is where you will see that the money is lost, or the money is actually not performing to an extent in terms of what the market conditions were. So this is a risky form of investment, but it is only done by very large multinational organizations, but it also helps them as an avenue to raise money. So here what we want to understand is the key takeaway that we want to do is this is an avenue to kind of raise long-term money for the company. It is normally done by multinational or very large organizations. And last but not the least, if I have to look at some drawbacks or disadvantages, what I would clearly say is this side of investment can sometimes be toxic or cannot return the rate of investment returns that you're looking at. So sometimes it is coming associated with financial risks. Now, government grants and EU, say for example, government grants, they basically mean that, sometimes the government tries to export or promote exports from the country, or try and develop infrastructure and, the employment in certain areas. So what they help do is sometimes the government will create something called export zones. And in these export zones, what they will say is, okay, if a business is set up and you're exporting and you're bringing in foreign exchange or foreign revenue, then the government would give you 3 years, 5 years, exemption on, say, duties or tax. And that is primarily done so that it allows the business to grow, but also the government is looking at a long-term plan wherein the business is able to generate income and employment opportunities within that area, and that area is then given the opportunity to develop. So government takes a calculated view in that case, wherein they try and do, they try and help the businesses set up, and in those cases they will provide you loans, and those loans can be written off, do not need to be returned in some cases, or will only partially need to be returned if you are able to achieve those significant targets which the government is setting for giving you those grants. So these are other avenues through which we look at long-term loans. Now let's briefly look at short-term. Short-term, could be 1 year, 2 year, 3 year. I'll give you an example of, your car loans, for example, or if you buy something which is, on a period of less than 5 to 10 years, classified as short-term loans. Sometimes you will look at, so you have a bit of a rate of interest on that, and you're paying the principal back. By the time the loan ends, you would have repaid the principal and the interest which is due, and the asset becomes yours. If you default on the loan, sometimes what will happen is the company will come back and repossess the car from you, or repossess the item from you that you bought because you've not been able to keep up with the payments. Now, overdraft facilities are basically, as I gave you an example earlier, like if you have a requirement of short-term, funds, you could go back to your bank, and the bank would say, okay, you are generating enough cash every month, we could extend that facility and give you slightly more, and that needs to be returned back. And in those cases, the bank manager or the local branch would be able to take a decision, because you've been banking with them, for a certain amount of time, and those decisions can help give you a bit of flexibility to businesses. For example, when they process wages towards the end of the month, what happens is there's a lot of money which might go out, and that would mean that when the new month starts, the company has little cash flow in the bank left. So what the bank would come in and do is give you an overdraft facility to process those wages, but because they know that your customers pay you on certain dates at the starting of the month, that money then is coming back, and then that overdraft will be, the gap in the gap, which is basically the overdraft, will be filled, and that is where they give you or extend that facility of, overdrawing the amount, then basically giving you some sort of credit to overdraw, but that is brought in back into the limit once the money hits in, because the cash flow in the business might require certain times money going out, more money going out than money coming in. There are other things that we look at in short term, which is trade credit. Sometimes you buy things, like a simple example is you buy things on credit card. Now, when you buy things on credit card, you pretty much get your product instantly, but most companies would have a limit wherein you have to pay the money back in 45 days or 55 days. And basically here is what you're looking at is getting some sort of credit. Now, assuming you settle the money payment, full payment, within those 45 days when you get the statement, you don't pay any interest. So basically what has happened is you've gained that money without a cost, no interest, nothing, and you've had it free for about a certain number of days. But if you go over that period, what tends to happen is there's a slight bit of interest charge which they apply, and that would essentially be giving you some sort of trade credit. The other factors that we look at in terms of short-term loan would be something called factoring and leasing. Now, sometimes you will see businesses lease a lot of equipment. It could be IT equipment, offices, cars, and things like that. Now, the reason why they look at leasing is that in some cases, this is being done primarily to use those products and services for business. And because they are using it for the purposes of business, instead of buying it, what they will do is use the option of leasing the asset without putting any capital into for buying the product. So for example, if you are a company, let's give you an example. If you are a company and you have say 500 members of staff, but most sales managers, when they join the company, they are given a car from the company. Now in those cases, the company does not want to go out and buy cars, because this is a product which will depreciate, it'll have a bit of wear and tear, and obviously because of the wear and tear, the value cannot be fully recovered back. So what most businesses would do is they would basically go out to a dealership and they would say, okay, we will buy cars or lease cars, not buy, lease cars, on hire purchase for a period of 3 years. So here the company is paying a fixed cost every month in terms of an installment, and in return, the company is basically providing them the cars to be used by the sales managers for various activities. Now, after the end of 3 years, what will happen is the company returns these cars back because you're not owning the product. What you're tending to do is you're using it on a monthly basis. The company has to pay a slightly higher amount in terms of usage. So what they do is, if you buy a car for 3 years, you might end up paying a certain amount, say £100 a month back as installment. But if you're leasing it, you might be paying £125 because you're not investing anything in terms of using the product upfront. And that concept is something literally called leasing. So here, the company would, once the lease ends, once the contract for usage for 3 year ends, the company might have an option to buy those at a depreciated cost because their product has been depreciating for 3 years. And that would mean that without putting in a single penny, they've used the product, but also have an opportunity to buy it, or if they don't want to buy it, they can return the car and get onto a new lease. And that would mean the repairs, the services, and everything which is related to the product is actually owned by the dealership, not by the company. So there is no liability that you need to have on your balance sheet. And in some cases, this is an option when you look at when a lot of companies buy machinery, plant, or things which they utilize in the business, and they know that the value of these products would depreciate as it is used over the period of time. And this then allows them to ease their cash flows or working capital cash flows from a point of view of leasing as against buying. Is that okay?
Yeah.
Okay. Good stuff. Let's look at some of the other things. I won't go into acquisition and mergers because I think I explained that with the example of Facebook, and WhatsApp. Now, let's look at some of the other options wherein we look at very briefly understanding, business angels. Now, business angels, as I explained to you, these are basically classified or defined as individuals or people who are entrepreneurs, definitely, but they have wealth or capital which they would want to invest in small firms in return for ownership. So here, generally, when you're looking at small investment, when I say small investment, I don't mean literally small, but when I say a lot of businesses, when they require money for growth, they tend to borrow money in certain, patterns. Now, if it's a startup business, work for 2-3 years. After that, they need to expand, maybe look at a better premises, more employees. They have a small demand in terms of growth which is required. And that would mean, you're looking at 100,000, 200,000 as a fixed cost that you need to be able to grow the business. So in those cases, what normally people will do is they do not tend to return this money. This money which businesses tend to borrow, they are not looking at returning it back, because once this is borrowed or invested into the business, this will become a part and parcel of the business. And this will normally go in areas wherein the money cannot be recovered. So it could go in the form of salaries, it could go in the form of assets. That means you're buying out a location or buying additional machinery. And that is where this investment in most cases cannot be returned back. Now, if you have to go and borrow money from the bank expects that you pay the money back, right? Whether you pay it in 5 years, 10 years, 15 years, but they do not want to take computers or obsoleted, equipment in return if you're not able to pay the money. Then if that is to happen, the company goes into administration and the liquidators are called in, and whatever they can recover from assets being sold, that is the last dire consequence which happens. But in most cases, when you look at organizations, when they look at, lending money to you like banks, what they would want is that you should be in a position to return the money. This money should be, returnable. But in the case of business angels, these individuals would basically not want the money back, and the company then approaches them because they are not looking at getting the money back, but they are looking at getting some part ownership of the company, or, they want to get some role within the company to be able to run the business along with them. Now, think of it as a situation wherein maybe a person has started a business and the business has come to a certain stage wherein he feels that he needs a partner, or he needs people who can come in and now take some additional responsibilities to be able to grow the business, because it has become big enough for him or her not to manage it alone, but they are looking at now managing it with professional help, and they need somebody to take it to the next level. So here they would typically approach people who are wealthy individuals, are entrepreneurs themselves, have run businesses in the past or have running businesses, and they would want to come in and make some investment become a owner, part owner of the business, and also take up a job function within the business. So this would mean that they are trying to bring in some best practices, and those best practices being brought in through part ownership, and the money not being returned because that money will be invested into the company to try and grow the company. Is that okay?
Yeah.
Okay.
Yeah.
Okay, good stuff. Now let's look at, so these additional slides, from slide 9 to I would say 13 would basically just expand what I've already kind of explained in the internal and the external and long-term and short-term sources of finance. But because we want to draw out clear differentiation between business angels and venture capitalists, what I've done is I've detailed these slides out that if you look at business angels, they normally would look at borrowing between 100,000 to say 500,000. This is as a benchmark within the UK. But if you look at other markets, it might vary. But typically, looking at $100,000 to 500,000, anything greater than 500,000 or $500,000 essentially would be considered as something called seeking out venture capital investment.
Sir,
And it
I
can,
have a question.
go ahead. Go ahead.
What I was going to ask is that business angels, they only look for the ownership benefit, or they could also expect some kind of interest from the amount they lend to the lenders. I mean the businessmen who need the money.
See, in terms of, good question, in terms of, to answer this directly, there will be two areas that they would look at considering. One is they look at getting some sort of an ownership in the company, and the second is they also want some sort of a role within the company. So
Okay.
they would want to come in on the board, say for example, become a director, and then have some part of the control of the business. And when they take up that position by investing that money, they also then end up running the business jointly, or becoming a part and parcel of the business to be able to run the business, to grow the business with the owner of the founder or the owner of the business. So here it is important for us to understand they are prepared to make an investment, but that investment normally would be not done just for the sake of investment, but that would also mean that they want to come in and take some ownership to run the business, to grow the business with the founder of the business. Is that okay?
Okay.
Right. I wouldn't go to say now the decision-making criteria on that would be that if you're trying to go to a business angel, you would not want to go to anybody who has money. But typically, owners here of the business would make an intelligent choice that they would go to people who have background of running similar businesses, have the experience and also the money to be able to come in and invest and do value addition by helping them to expand or tackle areas of issue which they are facing and which these people would have faced in their own businesses as well. So when they come in, they are not just able to bring in the money, but they also bring in the expertise and the experience to be able to solve issues and take the business to the next level. So a simple example that I would say is, if you're a sole trader and you have, say, for example, a shop or a news agent shop, then what you're trying to do is you've run the shop for a number of years, now you want to expand. So what they will do is they will go to somebody who's a bigger consortium which owns a number of shops in that area, and what they will do is, okay, we want to expand our ownership, or I want to become a part of your group, for example. What is it that would be required? So what the bigger company would do is they will not just invest money into the business, and that money which is invested might be taken off as profits by the current owner, but because he becomes a part and parcel of a bigger group, that would also make the problems of cash flow, procurement, purchases, other things which are needing to be managed easier, because they are then able to bring in the experience of running the business, because that person might have 5 shops or 6 shops as against you just having 1 shop. So the advantage would be when you procure, for example, stocks or negotiate trade terms, that person, because he has 5 shops and he's coming in tying up with you, he would have maybe better trade terms to negotiate credit with suppliers for 60 days or 90 days as against 30 days which you buy, because the buying capacity increases. So they're able to do value addition in multiple areas as against one area. Is that okay?
Yeah.
Okay, good stuff. Now, moving on to the second part of the learning outcome, wherein what we need to understand is when we know the sources of finance, we know the cost at which it is coming. We want to understand how financial information is looked at within, one or two slides. Just to recap, how do we relate the sources of finance to financial information? Now, when you have money coming into the company, we classify, money or capital coming into the company, and then that has to be reported in some sort of reports across the year. Because at the end of the day, in order for you to tabulate and use money, you need to create statements, or allocation of budgets have to happen in a way, right? So if you have certain budget for certain people want money in marketing, sales, production, engineering, you need to have some allocation of money done so that we know exactly what the money is being used for. Now, some of these statements, when we look at essentially calculation of money, we look at these three different types. One is financial statement. That means this is a reflection of how the money has been used, where the spend has happened. So a financial statement could be a profit and loss, could be a balance sheet, and this is primarily reporting what has happened on the money and how it has been spent. The second thing that we look at is something called management accounts. Now, these are things which basically tell us what is exactly happening at that point in time with money, and this holds current records. So in this case, we have statements like the income and expenditure statements, expenses statement. So basically anything which is on a monthly basis prepared or a weekly basis prepared to understand where the money is coming from, how much is going out, that would primarily classify into something called management accounts. Now, this depicts the information as of date, as on that present time. And the third one that we look at is we make some projections. We make some statements which will give us some tentative predictions or idea about how the finances are going to be used, or in terms of our situation, in terms of how the finances are coming into the company. And these would be classified as something called financial plans or budget. That means if you're starting a new year, new academic year, new financial year, new company year, what most departments, most companies would do is they will create some sort of a plan. That could be a sales plan, marketing plan, engineering plan, production plan, and at some stage when that plan relates to money or finances, that will be called a financial plan. So how much marketing budget do you want to create, or how much you want to spend this year, would be calculated or projected as some sort of a marketing plan, and the financials of that would kind of classify into something called financial planning. Now, this is normally done because you want to have predictability in the business. You want to know how much money is going to be coming in, and basis that, what are the investments the company is going to make. Now, these plans are not written in stone. That means they are not set in stone. They could change depending on the situation in the market, but these are developed to have some sort of planning done so that a book or a route can be planned when you're looking at spending or making spend on those expenses. Now, producing financial statements like balance sheet sometimes is also a responsibility, because under the company's law, or in most places, in most countries, you have some sort of a law wherein if you're trading as a public listed or a private limited company, as a limited company, or even as a trader, whatever it is, you need to be able to publish your financial statement, which needs to at some point in time be audited. I cannot just put in any information into it. It needs to be information which is reliable, and in some cases, this information has to be filed by the accountants within the company, or people who are qualified to form these statements. Now, sometimes these statements have to be audited, and when you say audited, because if you're going to get, say, apply for an application to get more finance, short-term, long-term, whatever it is, they would want to say that, okay, I could have produced this statement, I could have produced the balance sheet, and you could manipulate figures, but we want them to be audited. So what in that case happens is an external firm comes in to check your paperwork, or check how the statements have been prepared. And once they are satisfied that these are genuine accounts and there is nothing which is reflecting, which is incorrect in these accounts, they then tend to be something called auditors. So they will come in and do an independent view to check if this preparation of statements have been done in the right manner, following the rules and regulations, and everything in terms of what is reflected is accurate. That company would then be, going in coming in and doing an audit, they tend to be external to the organization because they work independently. And when they do the audit, they give you an audit certificate saying that, okay, the balance sheet and the statement being produced are absolutely genuine or, valid. And they then tend to kind of give you a statement of writing saying this is authentic. Now you get to hear, now this also can be manipulated. Sometimes you get to hear that, companies have declared more profits, and even if the statements have been audited, this slippage has happened wherein there is some sort of a, collusion which has happened wherein because of which the profits have been overreported or things like that. Now an example here would be Tesco, for example, in the UK, Toshiba, for example, in Japan. These companies overreported their profits, and these audits, their accounts and everything, financial statements were audited, but even then they were overreported. So there was so what has happened over the years in terms of investigation, they found that there was a bit of collusion between the auditors and the accountants in the company, and they tended to report these profits, in excess of what were generated in order to have the company's stock not take a beating in the stock market. And because of which these companies are fined, and management has to resign, corrective action procedures are put in place. But sometimes these things do happen, and they then are the responsibility of something called a financial regulator within the country. Now, in the case of US, we have Financial Conduct Authority, or FCA, and that is an authority which is an independent regulator which looks at monitoring banks, companies, transactions, and their job is to source out anomalies or catch hold of these flaws so that these kind of things do not happen. Now, because finance is so important for any company, any business, that is why these checks and measures have to be put in place. And typically, if you're working within a company, in terms of a business or a company, as a person who works within the finance department, there are lots of roles and responsibilities that you have as a manager, to work carefully, look at those statements, and that is what we will go through in the next few slides. Because the reason why we understand this is that finances at some stage, and the calculation basis of finances at some stage, allows the management to make decisions. Now, assuming if your company is working very well, you're generating sales, your revenue is increasing, then at some stage, if the owner of the company or the CEO of the company asks you to say, can you provide me the status in terms of profits for the last 3 years? So the financial manager, the person responsible, the department responsible for managing finances would produce reports, and these reports would say, okay, the company made this much profit in 2016, this much in 2017, and this is the estimated profit if we generate these sales to be generated in 2028. Now, basis this, the management would make decisions to either expand the operation, increase the business, or whatever it is, increase headcount, whatever could be the area. But these statements which are generated and maintained by accounts and finance department are then important piece of information on the basis of which decision making happens at the board level or at the senior management level when they look at expanding the operations of the company or whatever it is. Now, what we need to do, when we know the sources of finance, we know the cost at which they can be arranged, we know how they can be arranged, and we briefly know how and why these are prepared. What we are going to look at now would be the reasons of how this is used for decision making. And before we do that, what we want to be able to do is understand the role and responsibility of a person who works within this department as a manager, and understand what are his key roles to prepare these statements. So assume now, what I would suggest is wear a hat of being a manager within the company and working within the finance department. So here, if you are a finance manager, and what are your roles and responsibilities? Let's look at that. So one of the key roles and responsibilities would be to understand the financial statements, which are being produced by accountants. So what could be those statements? Balance sheet, profit and loss account, working capital statements, cash flow statements. These are various types of information which is coming out in the form of reports that you would need to study. Now, you need to be able to recognize that which of these statements is important for the day-to-day running of the company, and which of this is important to showcase the overall financial position of the company. So if I have to look at monthly, let me ask you a question. If I have to look at monthly, status of the business, which statement do you think, or which particular financial statement do you think you will want to look at as if you are a finance manager?
Financial statement would be monthly.
Yeah, if I have to look at on a monthly basis, what is the business? How is the business doing? Which particular statement or financial document would you look at from a manager's perspective to get that idea?
Profit and loss and balance sheet, because I believe they could be made on a monthly basis too if required.
Okay, that is fine. I would slightly change that. Balance sheet, I think, is a statement which is produced at the end of the year, right? When you, or maybe there are interim balance sheets which could be prepared every 6 months or 12 months. So these are statements which are prepared on a long-term basis to reflect the financial, health, or, say, for example, the financial position of the company. Profit and loss could be prepared monthly, and this could be trading profit and loss, which is being prepared monthly by the accounts. Because what they are looking at doing in that statement is they're looking at how much of profit or how much of sales is being generated, and how much of sales from that account they will be able to predict the profit and loss for the company. But in most essence, even this would be classified as something called, a longer term, statement which the business would produce, because you need to go through subsequent months of sales, say at least 3 months quarterly sales, 6 monthly sales, to be able to produce, a profit and loss statement. Because in some cases, your clients might be paying you in installments, and until the full money is realized, there will be, money showing as outstanding against that client. So normally this is a statement which will be produced, primarily on a little long-term basis. If I have to say that, on a monthly basis, if I have to prepare a statement, what will you look at in very basic sense? You would look at income and expenses. How much expenses are being incurred every month, and what is the income which is coming in to cover that expense. So one of the statements that you will look at, which kind of predicts day-to-day financial activity. Again, I'm not saying you're wrong, but what I'm saying is that let's understand smaller statements. Now, in a big company wherein there are 200 purchase orders being done, or if a company like Coke has to look at, on a daily basis, they would primarily look at, a statement like, not profit and loss, they would look at, a statement like cash flow statement, they will look at working capital, cash flow, income, expenses statement, because of the heavy area of activity. That would mean that this is going to give them an accurate picture of how many bottles or how many cases or crates have shipped out, to how many orders have come in, and against which it will be easier for the account manager to, at the end of the day, look at the profit and loss, look at the accounts, and that accounts would say, okay, so much orders came in, so much orders have been shipped out, and that is giving us this much flow of money coming into the organization. But when I would look at an overall financial position of the company, I would look at statements like what you mentioned, like which is the balance sheet and profit and loss account, because they retrospectively show the finance and the position of the finance within a company over a period of time, and that would be classified as something called an overall position. So when we look at managers digging into understanding what they have to look at on a daily basis, they would look at things like income statement, expenses statement, they would look at budget statements in particular, and those would be giving them position on a daily basis. Now the second thing that we look at is, if I have to understand how will the managers look at the health of the business. So sometimes they have to do some planning to understand, and when I say planning, that is financial planning, to understand and make some forecast that with the current set of business, current expenses, and the orders coming in, the business is viable and we are in profit, or we are in black, essentially, as we say, that the company is making money, and they then tend to make statements for 3 months, 6 months, 12 months, and 18 months, and these are called projection statements or projected financial statements. And these projected financial statements are very close to what exactly is being generated, received, and paid out on a daily, monthly basis. So in terms of money, when we look at those statements, these statements tends to be cash flow statements. These statements tend to be, working capital statements, because here the accountant is essentially looking at money coming in and money going out, and he's looking at doing a net at the end of the day to try and clearly understand that how much has come, how much the business has generated today, and what will be the expected generation tomorrow. Now, how is this done? If you look at most of the money being generated comes in from sales of products and services. So in a sales company, or in every company, there's a good importance of looking at, let's put it this way, sales pipeline. They would want to know how much each sales manager is generating over a point in time. So normally most people would employ some sort of a software which would allow them to predict sales from a point of view of orders coming in into the system. Now, because that gives some predictability and there is some sales pipeline, that would then be used by the accounts or the finance manager to create something called a projected financial statement, because it will take into account the orders or the projected orders which are supposed to hit the system at a point in time. And that would then tend to give them something called, projected statements for the business. And that also is something which most accountants and finance managers do within the organization. Now, briefly looking at one or two other things. Now, how does the finance manager make decisions, right? This is something that we need to understand. Now, in some cases, you would see that depending on the money available within the company, the finance manager would have to allocate that money to different types of requirements coming in. Sometimes you would see.
Can I have a question?
Go ahead.
I was just looking at the basic definition of the income expenditure statement and the profit and loss account. Aren't they both exactly the same thing when referring to them?
I would say probably not. Now, when you say income and expenditure statement, the income and expenditure statement would be primarily created to reflect a state of accounts. But that will be the starting point from which you will basically look at putting all the expenses and income in. And once that goes into the sheet, then at that stage it will give you some sort of a statement of accounts. But so they are like the building blocks of a particular statement. If you don't know what your income and expenses are, how would you start to put together a profit and loss account? So there's a slight bit of differentiation on that side, that these are building blocks for a statement as against projecting the financial position of a company at any given point in time. Okay. Is that okay? Right? So a simple example in that case would be, we know that there are, say, 10 employees in the company. We know the base salary of each employee, which is payable every month. So that we know is an expense, right, which will be paid out on the 30th of the month. Now, against that, the finance manager will look at what is the money coming in. So money coming in could be money coming in from sales, money coming in from interest, money coming in from, say, other sources, and that would be falling into income for the company. Now, when income and expenses are tabulated onto a particular statement, that the net of which would give you some sort of a projected profit or loss for that month or for that term for that company. Is that okay?
Yeah.
Okay. Now, in terms of, so what we are trying to look at is what is the role of, the financial manager, and how and what statements you use to understand the finances of the company. Now, some of the things that we look at is sometimes most managers are interested in finding out, okay, what is the income coming in? They're all interested in finding out what is the money hitting the bank, because he has a lot of invoices, a lot of purchase orders, a lot of other things to settle. So his aim at any given point in time, he's juggling with the fact that they are trying to look at what can be paid out and when it can be paid out. Because when you look at a running business, they have a lot of expenses. You have rent, electricity, water, gas, salaries, wages, purchases, invoices to be settled. So the person on a daily basis who's managing all this is more interested in finding out how much money is coming in and what invoices I can settle. There is no debt outstanding with the company. So what they tend to they look at cash flows, and in these cases, cash flows are typically generated by the products or services which the company is actually selling to, its customers. Now, the firm which is able, or the business which is able to sell more of its products and services on a daily basis is able to generate more cash, because when you sell a product, you get some money coming in. So, for example, if you go to a grocery store, you buy a few products, what you have to do is you can't just walk out from the grocery store without paying, but making the payment for whatever you bought from that store. Now, towards the end of the store day, when the store manager closes the store, what he does is he calculates the tills to see how much money has come in. And at some stage, most of these businesses employ a software which will give them that, okay, this much was the product sales, this is what the cost of sales was, or cost of goods was, and the net of that would give them the cash which is remaining within the till, and that cash is nothing but a cash that he can take home because he knows that is profit. Simple enough to understand?
Yeah.
Yeah. So essentially, when we look at small businesses, this is happening because for him the importance is cash flow. Net of whatever is left at the end of the day is something which the owner will take home, and that what he takes home is becoming his profit. Now, this is just a diagram to show that how a cash flow would typically work within a company of any size. So if it's a bigger company, smaller company, medium-sized company, it doesn't matter. But this is to explain how the cash flows are managed within a particular company, and looking at meeting up all the requirements of people, from that aspect. Now, the money coming into the business is generated by sales, which is depicted on A, the sales which could be of products and services, goods and services. Now, that money, when it comes in, is basically classified into something called current assets and productive assets. Now, productive assets would be companies which have manufacturing or engineering, and in that case, the net of expenses between the two gives you something called cash or residual cash. So if the money coming in is higher than the expenses incurred by the company, that means you will have some cash which is left out on a daily basis, and that cash could either be reinvested, saved in the bank as profits, or deposited in the bank to primarily use in the future. Now, if this is happening on a day in day out basis and calculated for the year, at some stage the company will publish a financial statement which could be a balance sheet, profit or loss account, and then the profit that the company makes is then reused for a lot of things. So if the company is listed on a stock exchange, you will see that the company will need to pay some dividends to its shareholders, and these dividends to shareholders would go across, a percentage of that will go across. But apart from that, whatever money is owed to the suppliers, the partners, the employees, or the government will be paid out, and the net of it will be retained as something called profits, and this is reflected in the profit and loss account and the balance sheet of the company at the end of the year. So every month, if I look at an activity, money coming in from the sale of product, goods and services, some part of that being reinvested into creation of those goods and services like raw material costs, manufacturing costs, net of which remains basically becomes the cash being deposited in the bank. Now, at the end of the month, you pay wages and salaries to the employees, you pay cash back to your suppliers because you have invoices, 30-day credit terms, whatever it is, and then some part of it is going out as taxes, VAT, or input tax which is being applied on goods and materials which the company buys, is going out as taxes to the government. And then if you have taken or borrowed money, then some part of that money which is being generated by the business would be paid back as interest and principal to its creditors. assuming you borrowed short-term, long-term, some part of that money coming in has to be looked at. As a financial manager, you would appropriate the funds to say, okay, I need to make these repayments for the loan or the deposit the company has taken from the bank or from investors, and that needs to be repaid without a default. And that would also appropriate on that side. So this is how typically a finance manager would look at the overall situation. So money coming in could be attributed into different types, but his main aim and goal at the end of the month is to look at managing expenses to say that, okay, the business is making profit, the business is not making profit. And if this is happening month on month, then his job is to sensitize the board and the management to say that the company is not generating enough cash or is not generating enough sales, and because of which the company might be making a loss. So in this case, one of the clear responsibilities of the manager would be to keep a track of how the company's finances are faring, and these finances then have to be tabled out as a report to the top management to say that the company is not making enough cash, or these are the areas in which the cash is not being generated, or the company is spending more than what it is earning. And that would allow the management to make decisions. Now, some of the other things that we look at, which I've explained briefly here, is that if the firm is not getting enough money, then obviously the business is unprofitable, and that is where he needs to sensitize the management. Now, the statement that he uses to do this, because he's looking at daily, weekly, monthly basis, is cash flow statements. Money coming in, money going out. Okay. Now, if the firm is not profitable or is not making enough money, then at some stage he sensitizes the management, and if assuming the management also does not do anything, there will be a default which will start to happen on repayments. And when the default starts to happen, the credit lines, the bank will withdraw all these things, and you are leading into a stage wherein the company is actually going bankrupt or is going into administration. Now, if the company is to file for administration or go into bankruptcy, basically what tends to happen in that case is the company is taken over by the main credit holders or shareholders, and they then tend to bring in auditors, which will look at systematically liquidating or selling off the assets of the company to realize what can be what can be achieved in terms of the sale to minimize the losses for which they have lent funds. And then in that case, the financial statements which the manager produces are utilized to basically come to that kind of conclusion. So the first thing which normally auditors would do when they come in and take over the company would be that they would sit with the finance manager and ask him to produce as of date financial statements, and these would be cash flow statements, these would be income and expenses statement, and what they would take a decision quickly would be to see where the money is going out from the company, and they would try and kind of sever or stop that outflow immediately. So in most cases, when you see if this process is to happen, the employees are made redundant very quickly, because the most important part of the outgoings within a company to a certain extent is the wage bill. So what most auditors tend to do is they tend to systematically lay off employees in order for the outflow of the company in order to reduce the outflow happening from the company. They will lay out or make people redundant in sales the last, or maybe the administration side of things tend to go, operational side of things tends to go. People who are working in engineering, production, manufacturing would kind of still stay, and people who are basically on the sales side would still stay, but at some stage they will decide which one have to go. But mostly the administration staff at some point in time tends to get affected quite quickly. Now, the other things that we look at when we look at the the basic fundamental roles of the finance manager in this case would be that they are required to do budgeting. Now, if you look at your personal self, every month, maybe your mom, your dad, or somebody who's the earner within the family, they would do a bit of budgeting. Say that, okay, I need to spend this much on food, this much on gas and fuel, this much on this much on clothes, this is what goes on rent, this is the miscellaneous expense. Now, why do you do this budgeting? The reason you do this budgeting is you want to live within your means. You know that this is the income coming in, and I need to be able to allocate and basically spend accordingly, so that I am able to live within what I've got in terms of income coming in, say for example salary. Now this is nothing but when you get into that stage when you start budgeting or putting some money or budgets across appropriate to certain activities, you're doing an activity called budgeting. And the reason you want to do budgeting is that it helps you take decisions that what I need to do or what I need to prioritize. Similarly, in a business, the financial manager or the person who manages finances always looks at doing budgeting. What is important, where the money needs to be paid first, what we need to buy, how much we need to buy is something that can only be produced or at any given stage known when the budgeting statement is produced. So in most cases, when you look at different departments, the companies will ask every month to produce a budget. So the head of the department, in the case of say marketing, will produce a marketing budget that this is what we are looking at spending, and this is the expected return, which is in terms of sales, which is going to come. The manufacturing would produce a budget which would say, okay, we need this much raw material, this is what it will cost, and we'll be able to deliver and produce these goods and services in this much time. Now, all this is nothing but creation of budgets or statements which give you what is required to be done at any given point in time. And once this is available, this is then available for taking a financial decision. Then if the products and services are to be produced, the first priority would be to allocate budgets to manufacturing so they can buy raw material and then obviously start producing the good. Once they are produced, and this is the ongoing cycle. It's not looking at every month. So every month the budgets go to buying the raw materials first, purchase orders, trade suppliers, and then towards the end of the month, because the money is coming in from sales and orders and everything, every company looks at booking, billing, and collection. So end of the month, there is a pressure on sales managers, there's departments to bring in the money for the sales which have been done, so that this can then be utilized to keep the company going in terms of expenses and income. So people have to be paid out, you have to place new purchase orders, buy new material, and that is all done using the budgets. And the budgets become quite important in the roles and responsibility of a financial managers, because if you do not know what you have to spend, if you do not know what is coming in, there is no way that you can prioritize expenses or know where the money is coming from and where the money is going. So budgeting is an important thing which the manager has to look at. Now, one last thing before I let's close today's session. It's become slightly longish, but let me close this session. Now, one of the last things that we look at in terms of financial decisions is, as you will see, increasing the complexity. So I'm going from daily basis to looking at cash flows, to looking at budgets, which is over a better period of time, and then going to working capital decisions, or looking at managing working capital, which will be normally quarterly, 6 monthly, and yearly. So this is bringing predictability into the business. So the basic statements that you do on a daily basis, weekly basis would be cash flows. After the cash flows have been produced, you do budgeting, which is normally a month. You won't do a budgeting for a day. You won't do a budgeting for a week. What you do is you normally do budgeting for longer periods of time. So after cash flows, you do budgeting. And then the third stage at which you start to do looking at managing this would be to produce statements. That you need to look at producing in terms of its finances by looking at generating something called a working capital statement. And then working capital statements are normally statements which can be produced in large businesses on a day-to-day basis, because there are lots of products being sold, lots of purchase orders and services being sold, and money coming in. But for smaller firms or medium-sized firms, these could be statements which are projection statements looking at a certain period of time. It could be 1 month, 3 months, 6 months, 12 months. And if there is mismanagement at this level, when you're dealing with working capital statements, this can drastically affect the business. That means the business can also falter, can go into administration, bankruptcy, and that is why these statements are very, very important to the finance manager. And the accuracy of these statements have to be maintained so that the decisions are as accurate as possible, and this then helps to bring predictability into the business and the operations of the business. Now, this particular exhibit kind of summarizes how a financial manager would look at statements on a short-term and on a long-term basis. So when you look at a balance sheet, what are the decisions which the financial manager or the person who's having the responsibility to manage finances would look at in a longer term basis? So in the long term, you look at, the balance sheet gives you asset and liabilities. It is nothing but asset and liability statement. And in this case, the changing situation of your assets and your liabilities produces or gives you something to produce, which is called the working capital statement. Now, long-term assets that you bought, like offices, machinery, which are not going anywhere, they are tangible assets, or it could be intangible assets in the case of companies like Facebook and Microsoft, wherein it's the software, but it's an IP or intellectual property. And in those cases, these long-term decisions, which are primarily looking at Windows coming out or Microsoft coming out with Windows 10, and that thing came out after 10 years of working into the product. Now this is long-term, and in this particular thing, there is, because it is taking a lot of gestation time to bring out the product, there is a lot of budgeting which is done to provide appropriate resources and finances to bring out that product, and that is where budgeting is done as a process. So budgeting tends to be a longer term process. It could be, depending on the firm. I'm giving you an example of a big firm like Microsoft. In that case, if they're working on a product or a product life cycle, 3-4 years in making Windows 10 after 2007, it took 3 years for that product to come out. So there would have been a lot of capital budgeting which would have been done to look at manpower cost, R&D costs, cost in terms of working on the product itself, different offices, and all that would have been done in terms of budgeting decisions. And once that has come out and the product has been released, then that is the time where the company is actually doing the sales of that product. And once the sales of the products are happening, then on a daily basis, you're looking at the cash flow statements of how much orders have been booked, how many sales have been booked, which area has contributed more sales. And when you look at those decisions, that to a certain extent starts giving information to the financial manager about how the product is performing, and then the management looks at those statements to make further decisions with regards to that product. So it gives you, this particular table gives you an idea in terms of what kind of statements allow what type of decisions to be taken if you work within the field of finance and within a company as a finance manager or as a accounts manager. Is that okay?
Yeah.
Okay. Any questions, Maliha?
Sir, I just wanted to ask you to upload the slides of Learning Outcome 1 and this to Learning Outcome 2.
That's fine. I'll do that after the session. No problem. Now, there is one. Yeah, go ahead.
No, it was actually not relevant. It was regarding the other unit. I was going to ask you about the feedback of my partial assignment.
That's fine. I'll send that across today.
Okay.
Now, this is a small handout which I've prepared, which will help you to understand what are the sources of finance. And in this case, my suggestion would be to try and take this up as a small exercise, because this will directly relate to your task 1.2, and task 2.1. So if you fill this up, this will allow you to finish off task 1.2 for the assignment, which will say that, okay, these are the internal sources, these are the external sources. You put some small definitions here. What is retained profit? What is the sale of assets? What is the advantage and what is the disadvantage? And this would cover that task up. So I'll send you this as a small exercise. If you complete this, this will directly meet, your requirements to understand, the sources of finance for task 1.2.
Okay.
Task 1.1 and 1.2. So we are looking at benefits and limitations of different sources. So benefits and limitations would be the advantages and disadvantages. And what we are listing out is the types of sources of finance here. So if I would do is I label this 1.1/1.2. Okay?
All right.
Any questions from you, Daniel?
No.
Okay, that's good. So let me send this. Did you get the copy of the presentation yesterday, Daniel, from Anjum?
Presentation? No.
Yeah.
Not yet.
Not yet, okay. So I will email both the copies of the presentation and the handouts to you for reading for the Learning Outcome 1 and Learning Outcome 2 today.
Okay.
Okay? And I will catch up with you. I think you'll have your sessions tomorrow with Phil, which is on Unit 3, Business Communication. And then Thursday again, Business Communication. And then Saturday, Sunday, we'll catch up, or Anjum will catch up with you on, the Unit 6, which is Finance, Introduction to Finance.
Okay.
Okay? Thank you so much for joining the session today, and I'll send you a copy of this presentation, yesterday's presentation, and some handouts for you to read in the next few minutes just after the session.
All right.
Okay, take care. Enjoy the rest of your day.